Now that we've had a look at tax-free investments on the one hand and retirement savings, which come in different forms on the other hand, we will now look at a comparison between the two. Firstly, let's see with regards to the tax deductibility of contributions. Tax-free investments come out of your after-tax income, so you can't deduct those contributions from your income or from your taxable income, while retirement funds, on the other hand, your contributions get deducted from your taxable income and therefore decrease your taxable income up to certain limits, as you can see on the screen. With a tax-free savings account, you can only contribute 36,000 Rand per year and 500,000 Rand over your lifetime. While with retirement funds, there's no limit as to how much you can contribute, although when it becomes over those limits that we mentioned in the previous slide, then you may no longer deduct it from your taxable income, and although you can deduct it in the following year of assessment. So remember to stick to your contribution limits with regards to tax-free investments, because if you contribute more than those amounts, then you get taxed at a higher rate. Next question, is there tax payable on your return? With a tax-free investment, there's no tax payable on your returns ever. So whenever you access that money and whenever income accrues to that investment, no tax is payable. With retirement funds, no tax will be paid while it is still invested in the fund, but when you withdraw the money, you will have to pay tax on the cash withdrawal, or when you use your pension to purchase an annuity, then you will pay normal tax on the annuity payments that you receive subsequent to that. With regards to accessing your investments, with the tax-free investments, you are given quite a lot of flexibility. You can withdraw it at any time, although of course it is beneficial for you to leave it in there as long as possible. With retirement funds, you can only access it once you have retired after the age of 55, or if you have to retire due to ill health, or when you immigrate. There are also circumstances where you can access up to a third of your pension if you lose your job. This links up to some of what we've discussed before, but with a tax-free investment, you do not pay any tax even when you withdraw the funds. With a retirement fund, you will have to pay tax once the funds are withdrawn and paid to you out of your retirement fund, so your pension fund or whatever fund it is. The next difference is that your pension savings in retirement funds are protected from creditors, while tax-free investments are not. So if someone were to get a judgment from you and they want to attach your assets, they cannot attach your pension fund, while they can attach a tax-free investment. And if you were to be insolvent or go bankrupt, your pension savings are protected, but your tax-free savings are not. So that's one favorable aspect of a pension savings. Then another favorable aspect of your pension savings or retirement savings are that it does not form part of your deceased estate, which means that it's not subject to estate duty. It can go directly to your beneficiaries of your estate. While with tax-free investments, that is not the case. It forms part of your estate and will attract estate duty, unless you have nominated a specific beneficiary, and this can only be done under some tax-free investment products. With both retirement savings and tax-free investments, there are limitations as to what you can invest in. With tax-free investments, it must be with a designated provider and the funds that you can invest in have to be passively managed. So they can't be actively managed ETF, for example, which means that a fund manager has discretion as to what they can invest in or not. It can only be invested in something like an index or something like that, an ETF that tracks an index. Retirement funds, there are also regulations that limit the amounts of offshore investment that they can invest in, but that may be actively managed by fund managers. And that's a brief comparison between the two. You can also access all of this in a table in the study materials, which kind of summarizes that. Thank you for watching.